Hey everyone, welcome back to Corporate Decoder, the place where we take complex financial documents and make them simple again. Let's just say FiscalNote's latest report has more twists and turns than a soap opera plot, and we are here to untangle it all. We are diving deep into FiscalNote Holdings Inc.'s quarterly filing for the period ending the 30th of September 2025. This report is packed with numbers that tell a story about the company's financial health, its strategies, and the hurdles it faces. Alright, let's jump right into the numbers, starting with their balance sheet. As of the 30th of September 2025, FiscalNote had total assets of about $273 million. That is down from over $326 million at the end of 2024. This drop isn't necessarily bad. It often comes from selling off parts of the business, and guess what? They did just that. The company has been busy. They sold off Dragonfly and Oxford Analytica in March 2025 for about $40 million. Then in July, they sold Timebase for another $7.4 million. Before that, in 2024, they sold Board.org for a whopping $90 million and iCell Technologies for nearly $10 million. These sales explain a big chunk of the decrease in assets, and more importantly, they freed up cash and let the company focus on its core business. Now let's look at how the company is actually making and losing money for the 3 months ending the 30th of September 2025. FiscalNote's total revenues were about $22.4 million. That is a pretty big drop, about 24% lower than the same time in 2024 when they brought in nearly $30 million. This revenue decline is mostly because they sold those businesses. Subscription revenue specifically dropped by over $6 million, that is almost 23%, and the bottom line looks tough. For the 3 months ending the 30th of September 2025, they had a net loss of almost $25 million. That is a lot worse than the nearly $15 million loss they had in the same period in 2024. For the first 9 months of 2025, the loss widened to over $42 million compared to a profit of $22.9 million in the same period in 2024. This shows the company is struggling to turn a profit despite those business sales. This is where things get interesting or maybe a bit confusing. FiscalNote has a lot of financial instruments like convertible notes and warrants. The value of these can swing wildly. For the third quarter of 2025, the change in the fair value of these instruments added a loss of about $7 million to their bottom line. That is a big increase from the $3.5 million loss in the same period last year. This volatility is a major factor in their unpredictable results. Now let's talk about something that definitely impacts their future. In August 2025, FiscalNote took out a new $75 million loan called the 2025 Senior Term Loan. This loan is secured by pretty much everything they own. It has a high interest rate plus 8% above SOFR, that is the secured overnight financing rate. Plus, they made big payments to pay off old loans. This means they are taking on significant debt obligations. This is a really important point. The company itself is raising a red flag. They are saying there is substantial doubt about their ability to continue as a going concern. This means they are worried they might not be able to pay their debts or keep operating for the next year. They have a lot of accumulated losses, and despite cost cutting and selling businesses, they are still burning through cash. The new loan covenants are tight and they could easily trip them if things don't improve fast. Here is another thing that gives us pause. FiscalNote admits they have a material weakness in their internal financial controls. This means they messed up on making sure all manual journal entries were properly reviewed and approved. The consequence, a higher risk of errors in their financial reporting, which could hurt investor confidence. They are working on fixing it, but it highlights some operational challenges. Looking at their revenue trends, they are mainly selling subscription services. About 93% of their income comes from these subscriptions. However, as we saw, their total revenues have dropped. Selling off parts of the business means less revenue overall. They had about $22.4 million in subscription revenue for the 3 months ending the 30th of September 2025, down from over $27 million a year earlier. They are also tracking something called net revenue retention. This tells them how much revenue they are keeping from existing customers. This number can go up or down depending on whether customers spend more or leave. Excluding those sold businesses, their NRR was 98% for the 3 months ending the 30th of September 2025 and 2024. This sounds good. It means they are retaining most of their core business, but it is crucial to remember that overall revenue is down because of the asset sales. They also report something called adjusted gross profit. This is basically their revenue minus the direct costs of providing their services, taking out some non-cash costs like amortization. For the September quarter, their adjusted gross profit was about $19.4 million, down from over $25 million a year earlier. Their adjusted gross profit margin, which is that profit as a percentage of revenue, stayed strong at 87%. This suggests that while they are selling less, the profit on what they sell is still decent. And then there is adjusted EBITDA. This is earnings before interest, taxes, depreciation, and amortization, with some other adjustments for things like gains and losses from selling businesses and stock-based costs. For the September quarter, adjusted EBITDA was about $2.2 million, down from $3.4 million a year earlier. Their adjusted EBITDA margin also dipped slightly. This is an important measure for them because it shows their operational cash flow generation. While it is down, it is still positive, which is a good sign in a tough financial period. Scroll liquidity and capital resources simple. Let's get back to that going concern issue. At the end of September 2025, FiscalNote had about $31.8 million in cash and short-term investments combined. That sounds like a lot, but remember they have massive debt obligations coming up and they are losing money every quarter. Their ability to keep operating relies heavily on new financing and strict cost control. It looks like FiscalNote is mostly clear of any major lawsuit headaches right now. They say they are not involved in any legal battles that would seriously hurt their business finances or ability to operate, which is good news. Now, for the reality check, their list of risks is long and concerning. A major one is the impact of a government shutdown. If the US government is not funded, it can delay or cancel contracts with public sector clients, which is a big chunk of their business. They also worry about bigger competitors and the complexity of selling to governments. And of course, there is that material weakness in their financial controls we talked about. So what is the story here? FiscalNote is in a tough spot. They are selling off parts of their business to raise cash and simplify operations. While this has boosted their balance sheet in the short term, it has also led to declining revenues and bigger losses. The company is heavily reliant on new debt and its ability to meet tough loan covenants. The fact that they are flagging a substantial doubt about their ability to continue as a going concern is a serious warning sign. They are trying to become more efficient and profitable, but the path forward is incredibly challenging. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching. See you next time.